Look, thanks for joining us here. We're happy that you're choosing to spend some time with us on Wednesday around lunch. This is our October investment webcast, and I'm Tony Welch, the Chief Investment Officer at Signature FD. We're going to try to keep these comments here to 15 minutes like we do every month. And you also have the option of submitting questions during the presentation. I actually had a couple pre-submitted, so that's great. We'll try to address those at the end. We'll try to get to any questions that you have. If I don't get to your question in real time, I'll definitely make sure I follow up via email. So when we're looking at markets, obviously a lot going on, but we're going to try to narrow the focus today, take a little bit of a long-term look, and here's what we have on the agenda. So we've spent much of this year in the camp that it was possible that we could have a no recession scenario in the United States. But over the last couple months, we've really had to shift our thinking on this. There's been enough deterioration in the indicators to now imply that recession is a higher probability than not over the next 12 months. And as for what that may mean for corporate earnings, we think there's about 10% downside, the way that the economic data is kind of shaping up thus far. But even if we're right that the economy is going to soften to the point of an official NBER defined recession, and earnings do come in, timing the market with that information is nearly impossible. And we're going to go over why that is today. And importantly, from a long-term investment perspective, valuations are giving us a much better margin of safety now in both stocks and bonds today. So we'll talk about that a little bit as well. So first, there's a ton of information that we can share on the economy itself and to show you kind of the direction that the economy's headed. But this index here rolls 10 indicators into one to give a broad read on how the leading economic data is looking. This is the Conference Board's leading economic index, and it combines jobs data, housing, manufacturing, credit, consumer expectations, and even the stock market performance itself. Now, the year-over-year change in the leading data, it's now crossed a threshold that's been consistent with the early stages of modern recessions. When this index has fallen by this much, that's coincided with economic contraction of about 2% annual. So there's several different ways that we can show you that recession risks are now high, but the summation of these kind of 10 data points, this sums it up well. Now, a big point of tension is the job market. We've not experienced a jobs plentiful recession really historically. Instead, in each recession, there's been job losses and rising unemployment rates to varying degrees. But we're entering this current spell of economic weakness this time around from essentially record job strength. So here in the bottom clip of this chart, what we're showing is the so-called jobs gap. That's the difference between labor demand and labor supply. This is one of the primary drivers of this so-called sticky inflation. Now, what the Fed is trying to do is they're trying to soften job openings without destroying existing jobs. And right now, that's actually sort of working. We can see here that the jobs gap has in fact rolled over. But the labor market is still historically tight. And we do have our doubts that a recession would not result in higher unemployment. But this is the soft landing scenario right here. But the needle is getting ever more difficult to thread. Now, what could a recession mean for earnings? Well, this chart here in the bottom plots the relationship between nominal economic growth and earnings growth. Now, remember that earnings are not inflation adjusted, and that's important. Corporate earnings are actually a good long-term inflation hedge. We can see that there's a clear relationship, though it's not perfect, between economic growth, which is the red line, and earnings growth, which is that dashed black line. Now, the shaded periods on this chart, those are recessions. Now, a few things that I want to point out. First, earnings collapsed in 2001 and 2008. But more generally, in a recession, earnings have fallen about 10%. Also note that in the inflationary recessions of 1970, 1974, and the early 1980s, nominal growth did not even really contract. And in those instances, earnings dropped, but the drop was mitigated to about 10% each time. So unless this upcoming recession turns into a major deflationary bust, which of course could happen, anything could happen, we suspect that earnings downside will look more like the recessions prior to 2001 than these last two. So I just told you that we think recession is a better than 50% shot, and earnings would likely contract about 10%. So shouldn't we step aside and wait for that to play out? Well, unfortunately, markets really don't make it that easy on us. Here I'm showing the performance of the S&P 500 in the final stages of a bear market, and that's all the red that you see on the left side of this table. Now note that in the last month of a bear market, the index has lost an average of about 17%, a median of 14%. This is that true kind of capitulation phase of a bear market where investors really begin to tap out. Now in black, we're showing the early stages of the ensuing bull markets. Now note that the advance has averaged 15% in the first month. You've gone up 32% in the first 3 months. Now, I can assure you that the headlines in the first month and 3 months of those bull markets have been pretty miserable. And that's, when the bear market low has tended to occur in history, is when the headlines have been pretty nasty and volatility is high. Now, what makes all of this even more difficult is that the market itself is the most leading indicator that we have for the economy. No macroeconomic or fundamental data is going to tell you that we've reached the low. Now let's go case by case to show you how the pattern has actually played out in past recessions and bear markets. So starting with 1957 on the left, this really showcases a textbook version of how a bear market low develops. In each of these charts, the blue dashed line is the market, the gold line is the economy, the purple line is jobs, and the red line is earnings. Now note that the market bottomed first, followed by the economy months later, then another few months, jobs finally bottomed, and finally earnings bottomed about a year after the market. That same pattern was followed in 1974. Now, the interesting thing about 1974, which we already touched on, was that earnings didn't contract very badly in 1974. Now, here's the 1980 bear market and the early 1990s decline. The exact same pattern is notable as the declines that we showed on the chart before. The market bottomed first, then the economy, then jobs, then earnings. Now, here's the global financial crisis and then the pandemic. These were slightly different, but the market did in fact bottom ahead of the other three variables in these cases as well. And finally, here's the bear market of the early 2000s, which was kind of the oddball here. And then on the right is what we're experiencing today. Now, what was unique about the dot-com drop was that the economic growth didn't really ever contract, but the blow up in tech earnings created a major bear market. So this was, that kind of makes this an odd case. Now contrast that with what we're seeing today, and it looks a lot more like a normal economic and bear market environment that I showed on the slides before. The market's fallen, and that's led the economy, earnings, and jobs. Now, real growth has begun to roll over, and it looks like earnings are starting to turn as well. And we suspect that payrolls will begin to contract. But as we've shown here in previous slides, you're not likely to get good news on growth, earnings, and jobs when the market is hitting its low. The headlines are probably going to be pretty bad on all three of those fronts. So this pattern makes it exceedingly difficult to time the market, and we want to make sure that we're invested in those early stages of a bull, given the very strong gains that have tended to occur early on in the cycle. So if economic and fundamental indicators are likely to lag considerably, that surely there must be something we can watch. And what we can do is we can use the tendency for extreme strength in those early stages of a bull market to our advantage. So some of the most effective indicators for alerting us that a new bull market has been born are technical indicators. One of those that we watch is the percentage of all stocks that are trading above their respective average price for the past 10 days. Now, historically, when that reaches 90% or more, it's been a sign that a new bull market is underway. The market has averaged a 17% gain over the next year, and 35 of 36 signals have proven accurate when you get this really strong short-term strength. Now, for confirmation purposes, we wouldn't just look to shorter term indicators. We want to see short-term strength give way to longer-term strength. So this chart here is the same concept as the one before, but instead of looking at the stocks that are above their respective average price of the past 10 days, it looks at the percentage of stocks trading above their average price of the last 50 days. This indicator thus far has a perfect track record where the market has actually been higher 20 out of 20 times, and the average gain a year later has been 18.5%. Importantly, downside volatility has all but evaporated when we get this type of confirmation. So these are the types of things that we look for in order to more confidently proclaim that the bear market's been slayed. The fundamental data would most likely confirm much later than the technical indicators. Now, that said, for the long haul, valuations matter quite a bit. Here in this chart, we're showing the subsequent 10-year annual return for the market based on the valuation that we began that 10-year period from. Now, these returns are all net of inflation, so these are real returns. We began the year here in this zone, in this extremely overvalued zone. Average real returns from this level of valuation have been the lowest that you can see on the chart. And note how incredibly wide the distribution of outcomes has been from this starting level of valuation. The variability in returns has been enormous when the starting valuation is sky high. Fortunately, this bear market has cheapened valuations, and now we're over here in this zone. The average real returns from here have been about the same as what you've gotten from the expensive zone, but the range of outcomes has narrowed considerably. So valuation at the end of September was about 17 times forward earnings. If forward price to earnings ratios come down a little bit more before it's all said and done and get down to 15.8 times, that would move us over here, where forward return profiles begin to look quite attractive and the range of positive outcomes shifts higher. Now, in the heat of the moment, it can be hard to think long-term when you have this much short-term volatility and the year has been this difficult. But that's exactly how we should be looking at markets, is through a longer-term lens right now. Now, part of the reason that forward PEs are even as high as they are today is that mega cap growth stocks remain fairly expensive. But the median large cap stock is trading at 16.7 times forward earnings, meaning many companies are cheaper than the index itself. And we find that small cap valuations are particularly compelling right now, with the median small cap stock trading at 13.2 times forward earnings. So that's cheap on an absolute basis, and small caps are also cheap relative to large caps. There's other examples of value and pockets of value in the equity market, but this is a good representation of small caps and the type of value you're getting in that space. Now let's finally turn to bonds, which have basically been downright miserable this year. Bonds began the year with rock bottom yields, and as yields have moved higher, bond prices have really taken it on the chin. But again, like stocks, bonds were very overvalued, and much of that overvalued condition has been worked off. Here in this chart, the gray bars show the range of yields in the past 10 years for various bond sectors. The diamonds show where yields are today. Note that in nearly every case, yields are at the top of their respective range and are far more compelling than they were at the start of the year. This means a drastically improved forward return profile for bonds as well. Now, this chart here showcases how starting yields bake in a margin of safety now for bond investors. With a higher starting yield, we're getting a better margin of safety. So again, we're showing various bond sectors, and the bars show the price impact to these sectors, with blue showing what could happen to bond prices if yields were to go 1% lower than they are today. And the gray bars are showing the impact to each sector should yields go 1% higher than they are today. Now, at the beginning of the year, with very low starting yields, this chart looked completely opposite. The downside was much greater than the upside. Now that's completely flipped, and the upside price appreciation potential is now greater than the downside risk. That's because higher yields do in fact build in a greater margin of safety on bonds. So like stocks, we'd be well served to view bonds with a longer term lens from here. Okay, so recapping today's webinar, the economy is now more likely than not heading towards some sort of contraction, but it would be starting from a place of very tight labor markets, potentially mitigating some of the downside risk. Now, we suspect that earnings could contract about 10%. Regardless of the economic outlook, we need to be cognizant that the headlines will likely look pretty bad when markets have hit their low point. Timing the markets based on economic and fundamental data is therefore unadvised. Stocks are now offering a better margin of safety from a valuation perspective, and that's particularly true for certain areas like small caps, and the same can be said for bonds. Okay, so with that said, let me check on the Q&A section and see what maybe is coming through the webinar, and I'll address some of the pre-submitted questions as well. Okay, good. So we have a few things to address. One, the housing market. So I think that is a very timely question. Really it boils down to what about housing? How are we thinking about housing? So yes, the housing market is something we're paying attention to. We need to pay attention to. House prices actually experienced a month-over-month contraction last month of a little over 1%. But they're still up pretty sharply in the past year. But it was notable to see that there was actually a mild contraction in house prices last month. So obviously, affordability is that metric that we need to pay attention to. The average mortgage rate over the past year, or the average mortgage rate is now roughly 7%. But there's still a supply-demand imbalance in housing. So this is certainly a different situation than in 2007 when supply was out of control. Buying activity can temporarily go on hold, but household formation is going to happen. And I suspect that if rates stabilize or come down a little bit here, housing activity is going to restart pretty quickly. And we even have kind of a sample of that. If you look at mortgage rates from June to August, they went from a high 5% range to under 5% from July to August, and housing starts immediately picked up. So I would call the housing market stunned right now, but yes, of course, it's something we need to watch. Housing investment is directly 3 to 5% of the economy, and consumption on housing services is another 12 to 13% of GDP. So certainly it's important and worth watching. A follow-up question on the housing, and I think it goes into some questions that we've gotten on inflation. So this is good. This will dovetail well, is how much of inflation is housing? And right now it's significant. So if you look in the CPI basket, housing is roughly a third of the CPI basket right now. Housing is one of the most lagging indicators in inflation, the way that it's calculated. And that's probably going to keep inflation somewhat sticky over the next couple months. But if you're getting month over month contractions or flat housing prices, you're going to see that roll over as well. So we did get a question on the inflation side about things to insulate a portfolio, like tips or gold, and how we're viewing that in terms of insulating portfolios against inflation. So you really have to separate those out into two separate things. First on tips, we kind of think about tips. One, there is some tips are more compelling now than they were at the beginning of the year. When I look at tips have a positive real yield at this point, and it was a negative real yield for a long time. So tips are more compelling than they were, but we really have to think about risk and return when we're taking a look at portfolios. And my general rule of thumb, it's kind of an investment principle, is with more risk comes more expected return. And so that's why an equity investor, a stock investor, can expect more long-term return than a corporate bond investor. They're taking equity risk. A corporate bond investor is taking default risk, but they're not taking the equity risk. That type of thing. Treasuries are removing the default risk. So you should expect treasuries to perform less so than corporate bonds. Tips are removing both the inflation risk and the default risk. So your expected future return on tips is going to be lower than these other asset classes, and that may be a trade-off that you want to make. That's kind of a personal decision, but I would say on tips, they do look more attractive with a positive real yield than when they had a negative real yield. Now, gold is kind of the opposite. Gold, I really don't view gold as an inflation hedge. Gold is more so influenced by what real interest rates are doing, and that's why gold has kind of been miserable this year, because real interest rates have gone up, and that's negatively impacted gold. So I don't think that we should view gold in the context of an inflation hedge. It's really a speculative asset or a collectible that's going to move with real interest rates, and that's kind of how we would view gold. Question around here under what we're using for forward earnings. I don't know what on the S&P, because we showed valuations based off of forward PEs for numerous asset classes. I don't recall what exactly the number per share is, but we're generally using a compilation of analyst estimates that we get from various research providers on that. You can make the case that forward earnings may undershoot what analysts are expecting, and I think that's a pretty good case to make. Actually, analysts really never get earnings right. However, when you go and look at what valuation metrics have the best predictive ability for future returns, believe it or not, forward price to earnings ratios are one of the best at predicting future returns. So even though analysts typically get it wrong over the next 12 months, your forward PE ratio does a good job of showing you kind of how much pain the market has taken, and that it kind of works that way. Question here on will the Fed go 75 basis points in November? I think the package of data, again, we're not Fed whisperers here. The Fed has been very good at forecasting what they're going to do. And right now, the bond market is pricing in 100% probability that the Fed's going to do 75 basis points in November. So I don't think we're smarter than the bond market, and the bond market pricing in 100% of 75 basis points in November. I think we got to go with that. The package of economic data has simply been too strong for the Fed to pivot off of that yet. We got industrial production this last month was actually quite strong. Jobs are still pretty strong, and some of the sticky metrics of inflation are still pretty pretty high. So so I think 0.75% is likely in November. It's going to be more interesting to see what happens in December. Okay, a couple more questions, and I really thank everybody for sticking with us. These are great questions. Really, my favorite part of these webcasts. One, here's a good one about, are we likely to see some similar moves in asset markets like we've seen in England and Japan? I mean, when we look at England, the bond market really had a sharp negative reaction. Recently, Japan, the currency has really been getting crunched here. You know, are we likely to see anything like that in the US? So I think that's a great question. I'd preface this with, there's a non-zero chance of some sort of policy error in the US that could take us down that route. But if you kind of take these each in their own cases, you know, the US is following a policy mix that is way more conventional than England or Japan. And I think that's helping quite a bit with confidence in the US system. England was spurred by unfunded tax cuts. You know, the new prime minister there tried to pass through unfunded tax cuts in a hugely inflationary regime. And the bond vigilantes came out and really forced their hands and made them unroll or roll back those potential plans. And actually, the bond market and the currency has recovered pretty nicely in the UK following that rollback. And then in Japan, you know, they've been really artificially suppressing interest rates here, trying to import some inflation into their economy. And the currency has really been taking on the chin because of that. And our Fed is doing the opposite. You know, our Fed is really doing whatever it takes to try to anchor inflation expectations lower. So again, non-zero chance that you see something like that in the US, but it doesn't seem like we're heading down those policy mixes that we saw in England and Japan that caused those caused the pain there. Another couple good questions. Here's one on disruptions to the supply chains. You know, I think this is interesting. The kind of the regulatory environment, especially as it pertains to China, the semiconductors, kind of restrictions, the export restrictions on semiconductors to China, and what are the downstream repercussions of that. So I think it would take a whole hour-long presentation to go over all the repercussions of what's happening around the globe right now. But if I could just boil it down to a high level, a major theme that we think is going to play out over the next decade or so is it's not so much deglobalization. I mean, deglobalization is one way to put it, but more regionalization. You know, national security and supply chain resiliency, those are pretty much official policy stances among both parties right now in the US. It's rare that both parties agree on one thing, but they seem to agree on the national security issues around the supply chain, around chips and that type of stuff. So that really makes it official US policy. And that's important because more focus on national security and the supply chain resiliency rather than economic maximalization, that all in all kind of means a higher level of structural inflation than we've seen through the globalization period. Now, what does that mean for inflation? I mean, it probably doesn't mean 9% inflation, but prior to the fall of the Berlin Wall, you were looking at average rates of inflation around 3% in the economy or so. And I think that's more realistic to expect inflation rates rather than sub 2, inflation rates around 3%, steady state as we go through this supply chain normalization process. So there's a lot of different ways we can answer that question. It's a great question, but all things equal, this regionalization is probably going to result in you know, a little bit more inflationary pressure long term. And then kind of the last question on inflation that we've got, and this is the last question I'm seeing right now, unless anything comes in, is noticing some fueling costs have gone up of late. And that's especially true of diesel when you look at diesel prices. you know, and should we expect kind of higher CPI levels this winter because of what's going on with fueling costs? And the way that I would kind of answer that is kind of looking at that CPI basket. I think our question around how much inflation is in housing, if we take a look at energy and turn that over to energy, energy is about 8% of the consumer price index basket. Energy is always going to be a near-term swing factor in the inflation prints that we get. But offsetting the rise in diesel, you know, retail gas prices were coming off their low a little bit, but they've started to turn lower again. Natural gas is fairly controlled right now, so other areas of the energy complex have been pretty controlled. And diesel has seemingly, at least very near term, diesel is peaked and started to move a little bit lower. Of the CPI components, you know, when we think about where CPI is going or where it could spike, you know, you really need to look at how it's broken down. And again, housing is about 1/3 of CPI. Non-energy commodities is about 21% of CPI. Food is 14%, and then energy is about that 8% mix. So we know housing is going to be stubborn through the winter, just the way that it's calculated. But other commodities have been falling. Durable goods are either flat or down in a lot of cases. So I do suspect that that inflation is going to continue to make progress, and that 9% or so peak that we saw in the summer will probably be the peak that we see inflation for this cycle. And then again, when housing does start to move into the calculation and soften, you could see inflation move meaningfully lower quite fast next year. So that's kind of how we would break that down and look at it. Okay, guys, well, that takes us to about the half hour that we allocate for this. You know, if you have any further questions at all, you know, please feel free to message us. You know, I'm just tony.welch@signaturefd.com. Have no problem responding to questions that you have following the webinar. Very much appreciate your attendance and participation, and wish you all a great rest of the afternoon.